Welcome back to FinWise, part 4 of our cash flow statement series. If you haven't watched parts 1, 2 and 3 yet, about 3 main components of cash flow statements, please go check those out first because they set the foundation for what we're covering here in the part 4. Up to this point, we have examined the 3 essential components of the cash flow statement. First, cash flow from operating activities, which reflects the cash generated from the company's core business operations. Next, cash flow from investing activities, which shows the cash used for or received from buying and selling assets. And finally, cash flow from financing activities, which highlights how the company raises capital or repays funds. Now in part 4, it's time to bring all these elements together. We will look at how they combine to give us the total cash flow and how that figure connects directly to the balance sheet, providing the complete picture of a company's financial health. When we look at the cash flow statement as a whole, the total cash flow is simply the sum of 3 components: operating cash flow, plus investing cash flow, plus financing cash flow. This total tells us whether the company's cash position has improved or declined over the period. If the total cash flow is positive, it means the company has generated more cash than it spent, a strong indicator of financial health and stability. If the total cash flow is negative, it means more cash is leaving the business than coming in. That's not automatically a red flag, but it does warrant a closer look. For example, might be investing heavily in growth or returning capital to shareholders, both of which can be strategic decisions. So, interpreting total cash flow always requires context. It's not just about the number, it's about understanding why that number exists. Let's now interpret the cash flow results for the year 2025. Operating cash flow is positive with $2.8 million, indicating strong cash generation from the company's core business activities. Then negative investing cash flow of $1.3 million, reflecting outflows related to asset purchases or strategic investments. And the negative financing cash flow is $1.4 million, showing repayments of borrowings, dividend distributions, or share buybacks. When we add these 3 components, the net cash flow for the financial year 2025 is positive $124,000. This means that overall, the company generated more cash than it spent. This outcome suggests 3 key insights. The business is successfully generating cash from operations. It is actively reinvesting to support future growth. And it is returning capital to shareholders, either through dividends or share repurchases. Taken all together, these signals that the company is financially sound and managing its cash flows with discipline and strategic intent. That is a financially healthy company.